the Middle East's homegrown music streaming platform, recently announced it was going public by merging with a special purpose acquisition company, or SPAC, and becoming the first Arab technology company to list on Nasdaq. SPACs have been around for decades. In recent years, they've become more popular, attracting big-name underwriters and investors, and raised a record $82.1 billion in 2020, a six-fold increase from the previous year's record high. So what is a special purpose acquisition company exactly? A SPAC is a company with no commercial operations, formed strictly to raise capital through an initial public offering, IPO. SPACs are generally formed by investors or sponsors with expertise in a particular industry or business sector. Their aim is to buy or merge with an existing firm in an emerging sector or industry and take it public. When creating a SPAC, the founders sometimes have at least one acquisition target in mind, but they don't usually disclose the target. This is why they are called blank check companies. IPO investors that go through a SPAC have no idea what company they will ultimately be investing in. SPACs look for underwriters and institutional investors before offering shares to the public. Funds raised cannot be dispersed except to complete an acquisition or to return money to investors. A SPAC generally has 2 years to complete a deal or face liquidation. After an acquisition, a SPAC is usually listed on one of the major stock exchanges. What are the advantages of a SPAC? Being acquired by a SPAC offers young, fast-growing companies a faster IPO process under the guidance of an experienced partner. SPACs can accelerate a company's market entry by anywhere between 2 and 4 months, since there are fewer questions to answer given the lack of financial statements and related material, shortening the audition process. Going public through a SPAC also offers more pricing transparency, avoiding concerns about the swings in broader market sentiment. It also offers added insurance of having a long-term investor base via a PIPE, private investment in public equity, instead of attempting to sell to public investors at a roadshow. SPACs may now see some drop-off in 2021 after 2020's surge, and with investors expressing concerns that a SPAC market bubble could be forming. It will also become an increasingly competitive playing field. With an abundance of SPACs chasing deals, target companies can pit sponsors against each other in SPAC-off contests. This gives entrepreneurs more leverage over SPACs founders. The SPAC boom has nevertheless created an enormous number of mergers and acquisitions opportunities, and it's expected they will continue to be popular since they offer a really efficient way to raise capital. After a strong run of acquisitions in the US, SPACs are also looking to emerging markets with a focus on Asia and potential targets in the Middle East and in the UAE in particular.